A listed company plans to raise 120 crore through a preferential issue to a qualified institutional buyer, QIB. If the company's post-issue paid-up capital is 600 crore, what is the maximum permissible limit for the preferential issue under SEBI ICDR Regulations, and does this issue comply? Consider the limit for preferential issues to be 25% of the post-issue paid-up capital. Here are your options. A. Maximum limit is 150 crore. The issue complies as 120 crore less than 150 crore. B. Maximum limit is 120 crore. The issue complies as 120 crore equals the limit. C. Maximum limit is 100 crore. The issue does not comply as 120 crore greater than 100 crore. Or D. Maximum limit is 180 crore. The issue complies as 120 crore less than 180 crore. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. SEBI ICDR allows preferential issues up to 25% of post-issue paid-up capital. 25% of 600 crore equals 150 crore. Since 120 crore less than 150 crore, the issue complies with ICDR limits. Let's tackle this exam question. An unlisted company intends to make an IPO to raise 80 crore. As per SEBI ICDR regulations, which of the following conditions must be fulfilled regarding the minimum post-issue capital and promoter eligibility to be eligible for an IPO? Here are your options. A. Post-issue capital should be at least 50 crore and promoters must be from listed companies. B. Post-issue capital can be any amount, but promoters must have 5 years industry experience. C. Post-issue capital should be at least 25 crore and promoters can be debarred if disclosed. Or D. Post-issue capital should be at least 10 crore and promoters should not be debarred by SEBI. Take a moment to pause the video and decide. The correct answer is Option D. Let's see why. Under ICDR, unlisted companies must have a minimum post-issue capital of 10 crore and none of the promoters or directors should be debarred by SEBI from accessing capital markets. Moving on to the next one. A listed company issues 1 lakh equity shares in a rights issue at 150 per share with a face value of 10. If the existing paid-up capital is 10 crore, what is the maximum amount that can be raised through this rights issue, assuming no other regulatory restrictions? Here are your options. A. 1.5 crore. B. 15 crore. C. 10 crore. Or D. 1 crore. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Rights issue proceeds equals number of shares, issue price equals 1 lakh multiplied by 150 equals 1.5 crore. Paid-up capital is not a limiting factor in this question, so 1.5 crore is the amount raised. Moving on to the next one. An SME company plans an IPO of 12 crore. According to SEBI ICDR, what is the minimum post-issue paid-up capital required and what is the maximum issue size permissible under SME IPO norms? Here are your options. A. Minimum 10 crore paid-up capital, maximum issue size 10 crore. B. No minimum capital, maximum issue size 50 crore. C. Minimum 10 crore paid-up capital, maximum issue size 25 crore. Or D. Minimum 5 crore paid-up capital, maximum issue size 10 crore. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. SEBI mandates minimum post-issue capital of 10 crore for SME IPOs and the maximum issue size permissible is 25 crore under SME IPO regulations. Moving on to the next one. A company is issuing Indian Depository Receipts, IDRs, with a face value of 10 each. The issue size is 50 crore. SEBI ICDR regulations require disclosures and eligibility criteria for IDRs. Which of the following statements is correct regarding the eligibility of the issuer and the role of merchant bankers in this issue? Here are your options. A. Issuer must be a foreign company. Merchant banker is responsible for disclosures and underwriting. B. Issuer must be an Indian company. Merchant banker only advises. C. Issuer can be any company, merchant banker has no role. Or D. Issuer must be listed, merchant banker is only underwriter. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. IDRs are issued by foreign companies to raise capital in India. Merchant bankers play a critical role in ensuring compliance with disclosures and underwriting the issue. Here is another practice question. A company plans a preferential issue of shares at a price of 120 when the last 30 days volume weighted average price VWAP is 100. According to SEBI ICDR, what is the minimum price at which the company should issue shares, and does the proposed price comply? Here are your options. A. Minimum price 110, proposed price complies. B. Minimum price 120, proposed price complies. C. Minimum price 100, proposed price complies. Or D. Minimum price 130, proposed price does not comply. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. SEBI ICDR mandates that preferential issue price should not be less than the higher of the average VWAP for last 30 days. Here, 100 is minimum price. Proposed 120 complies. Test your knowledge with this one. A listed company issued a qualified institutional placement QIP of 20 lakh shares at 180 each. Its existing paid-up capital is 50 crore with face value 10. What is the impact on the company's paid-up capital post-QIP, assuming all shares are equity shares? Here are your options. A. Increase by 2 crore to 52 crore. B. Increase by 36 crore to 86 crore. C. Increase by 20 crore to 70 crore. Or D. No change in paid-up capital. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Paid-up capital increases by number of shares, face value, equals 20 lakh, 10, equals 2 crore. Total paid-up capital post-QIP equals 50 crore plus 2 crore equals 52 crore. Moving on to the next one. A promoter holding 40% in a listed company is planning a preferential issue to raise 30 crore. The company's post-issue paid-up capital will be 180 crore. According to SEBI ICDR, is this issue valid if the maximum permissible preferential issue is 25% of post-issue capital? Here are your options. A. Yes, because 30 crore less than 25% of 180 crore. B. No, preferential issue not allowed for promoters. C. No, because 30 crore greater than 25% of 180 crore. Or D. Yes, because promoter holding is 40%. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. 25% of 180 crore equals 45 crore. 30 crore less than 45 crore, so the preferential issue complies with SEBI ICDR limits. Moving on to the next one. A listed company under SEBI ICDR plans a rights issue with a record date on the 1st of March. If the issue opens on the 15th of March and closes on the 29th of March, what is the minimum and maximum time frame allowed between the record date and issue closure as per ICDR? Here are your options. A. Minimum 10 days and maximum 30 days. B. Minimum 14 days and maximum 30 days. C. Minimum 7 days and maximum 45 days. Or D. Minimum 15 days and maximum 60 days. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. SEBI ICDR mandates that the issue opening date should be at least 14 days after the record date, and the issue should close within 30 days from the opening date. Here is another practice question. A merchant banker advising a rights issue finds that one promoter is debarred by SEBI from accessing the capital market. According to SEBI ICDR Regulations, is the issuer eligible to proceed with the rights issue? Here are your options. A. No. Issuer is not eligible if any promoter is debarred. B. Yes. if the debarred promoter does not participate? C. Yes, if the promoter has disclosed the debarment. Or D. No, unless SEBI grants special exemption. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. SEBI ICDR prohibits issuers from making public or rights issues if any promoter/director is debarred from accessing capital markets. Here is another practice question. A listed company's equity shares are priced at 200 with a face value of 10. For a preferential issue, SEBI ICDR requires the price to be determined based on volume-weighted average price, VWAP. The VWAP for last 30 days is 190 and for last 60 days is 195. What price should the company offer for the preferential issue shares? Here are your options. A. 195, B. 190, C. 185, or D. 200. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. SEBI ICDR requires the preferential issue price to be the higher of the VWAP for last 30 days or last 60 days. Here, 195 greater than 190, so 195 is minimum price. An SME company with a post-issue capital of 12 crore wants to raise 8 crore through IPO. As per SEBI ICDR, does this IPO comply with SME IPO regulations regarding issue size and minimum capital? Here are your options. A. No, capital is below minimum required. B. No, issue size exceeds maximum allowed. C. Yes, since issue size is less than 25 crore and capital is above 10 crore. Or D. Yes, issue size and capital have no restrictions. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. SEBI allows SME IPOs with issue size up to 25 crore and minimum post-issue capital of 10 crore. Both conditions are met. Let's tackle this exam question. A company is planning a further public offer, FPO, of 100 crore. The merchant banker is required to ensure disclosures as per SEBI ICDR. If the company's promoter holding is 60%, what is the minimum promoter holding after the FPO as required by SEBI? Here are your options. A. No minimum promoter holding required post FPO. B. At least 25%. C. At least 50%. Or D. At least 75%. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. SEBI ICDR does not mandate minimum promoter holding after FPO. Such requirements apply mainly to IPOs or specific cases. Moving on to the next one. An unlisted company intends to raise 90 crore through an IPO. As per SEBI ICDR regulations, the minimum post-issue paid-up capital required for eligibility is 10 crore, and none of its promoters or directors are debarred from accessing the capital market. If the company's pre-issue paid-up capital is 8 crore, what is the minimum amount that must be raised to comply with ICDR regulations, and is the planned issue size adequate? Here are your options. A. Minimum raise required is 2 crore. Planned issue of 90 crore is adequate. B. Minimum raise required is 10 crore. Planned issue of 90 crore is adequate. C. Minimum raise required is 12 crore. Planned issue of 90 crore is adequate. Or D. Minimum raise required is 10 crore. Planned issue of 90 crore is not adequate. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Minimum post-issue paid-up capital required is 10 crore. Current paid-up capital is 8 crore. Therefore, minimum raise equals 10 crore minus 8 crore equals 2 crore. Since the company plans to raise 90 crore, which is much higher than the minimum required, the planned issue is adequate and complies with SEBI ICDR eligibility criteria. Moving on to the next one. An SME company plans an IPO to raise 15 crore. SEBI ICDR specifies that the minimum post-issue paid-up capital for an SME IPO is 10 crore and maximum issue size is 25 crore. If the company's pre-issue paid-up capital is 5 crore, does the company meet the minimum capital and issue size requirements? And what is the minimum amount the company must raise? Here are your options. A. Minimum raise required is 10 crore. The planned 15 crore raise complies with SME IPO norms. B. Minimum raise required is 5 crore. The planned 15 crore raise does not comply with SME IPO norms. C. Minimum raise required is 5 crore. The planned 15 crore raise complies with SME IPO norms. Or D. Minimum raise required is 10 crore. The planned 15 crore raise does not comply with SME IPO norms. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. Minimum post-issue capital required is 10 crore. Pre-issue capital is 5 crore, so minimum raise equals 10 crore minus 5 crore equals 5 crore. The planned issue size is 15 crore, which is within the maximum limit of 25 crore and above the minimum required. Therefore, the planned IPO complies with SME IPO regulations. A company is issuing Indian Depository Receipts (IDRs) with a face value of 10 each, planning an issue size of 60 crore. According to SEBI ICDR Regulations, which of the following statements is correct regarding the eligibility of the issuer and the role of merchant bankers in this issue? Here are your options. A. The issuer must be a foreign company and the merchant banker is responsible for ensuring regulatory compliance and disclosures for the IDR issue. B. The issuer must be an Indian company and the merchant banker has no role in IDR issues. C. The issuer can be any company and merchant bankers only underwrite but do not advise on IDR issues. Or D. The issuer must be a foreign company and merchant bankers are responsible only for underwriting. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. IDRs represent equity shares of a foreign company issued to Indian investors. SEBI ICDR mandates that the issuer must be a foreign company. Merchant bankers play a crucial role in ensuring compliance with disclosure requirements, eligibility criteria, and overall regulatory framework for IDR issues, acting as advisors and intermediaries. Moving on to the next one. A listed company proposes a preferential issue of shares at 120 each when the 30-day volume-weighted average price (VWAP) is 100. As per SEBI ICDR regulations, what is the minimum price at which the shares should be issued and does the proposed price comply? Here are your options. A. Minimum price is 120. The proposed price complies. B. Minimum price is 100. The proposed price complies. C. Minimum price is 110. The proposed price does not comply. Or D. Minimum price is 100. The proposed price does not comply. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. SEBI ICDR mandates that the preferential issue price should not be less than the higher of the last 30 days VWAP or the face value. Since the VWAP is 100 and the face value is typically 10, the minimum price is 100. The proposed price of 120 is above the minimum. Hence, it complies with the regulations. Test your knowledge with this one. A listed company with a current paid-up capital of 400 crore plans a qualified institutional placement, QIP, to raise 100 crore by issuing equity shares at 250 each. If the face value of each share is 10, calculate the post-issue paid-up capital and determine whether the issue complies with SEBI ICDR limits on QIP size being 25% of the paid-up capital pre-issue. Additionally, what is the minimum promoter holding required post-QIP if the current promoter holding is 60%? Here are your options. A. Post-issue capital is 440 crore. Issue exceeds 25% limit. Minimum promoter holding post-QIP is 50%. B. Post-issue capital is 440 crore. Issue complies with 25% limit. Minimum promoter holding post-QIP is 54%. Or D. Post-issue capital is 440 crore. Issue complies with 25% limit. Minimum promoter holding post-QIP is 54%. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. Number of shares issued equals 100 crore divided by 250 equals 40 lakh shares. Face value per share is 10, so paid up capital increases by 40 lakh into 10 equals 4 crore. Post-issue paid up capital equals 400 crore plus 4 crore equals 404 crore. Approx 440 crore in options assumed to include premium, but only paid up capital counts, face value. For QIP size limits, the issue size can be up to 25% of pre-issue paid up capital. 25% of 400 crore equals 100 crore, so the issue complies. Minimum promoter holding post-issue as per SEBI ICDR is 50% or higher. Given 60% pre-issue, post-issue holding cannot fall below 54%. Hence, correct answer is D. Let's tackle this exam question. A listed company proposes a preferential issue of 1 crore shares at 120 each. The 30-day volume-weighted average price, VWAP, is 100 and the 60-day VWAP is 105. The post-issue paid-up capital will be 500 crore. According to SEBI ICDR Regulations, what is the minimum price at which shares should be issued, and does the proposed price comply? Also, what is the maximum permissible size of preferential issue as a percentage of post-issue capital if the limit is 25%? Here are your options. A. Minimum price 105, proposed price complies, maximum preferential issue size 125 crore. B. Minimum price 100, proposed price complies, maximum preferential issue size 100 crore. C. Minimum price 105, proposed price does not comply, maximum preferential issue size 100 crore. Or D. Minimum price 100, proposed price does not comply, maximum preferential issue size 100 crore. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. SEBI ICDR requires preferential issue pricing to be not less than the higher of the 30-day or 60-day VWAP. Here, 60-day VWAP is 105, which is higher than 30-day VWAP 100, so minimum price is 105. Proposed price 120 exceeds minimum price, so it complies. Maximum preferential issue size is 25% of post-issue paid-up capital equals 25% of 500 crore equals 125 crore. Test your knowledge with this one. A listed company with an existing paid-up capital of 200 crore plans a qualified institutional placement, QIP, to raise 50 crore by issuing equity shares at 125 each, face value 10. According to SEBI ICDR regulations, the maximum QIP size is 25% of the pre-issue paid-up capital. Post-issue, the promoter holding is expected to reduce from 65% to 55%. Analyze whether 1. The QIP issue size complies with SEBI limits, 2. The post-issue promoter holding meets minimum regulatory requirements, and 3. Calculate the post-issue paid-up capital. Here are your options. A. QIP size is within limit, promoter holding is above 50%, post-issue capital is 240 crore. B. QIP size is within limit, promoter holding is below 50%, post-issue capital is 250 crore. C. QIP size exceeds limit, promoter holding is below 50%, post-issue capital is 250 crore. Or D. QIP size exceeds limit, promoter holding is above 50%, post-issue capital is 240 crore. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. Maximum QIP size allowed is 25% of pre-issue capital. 25% of 200 crore equals 50 crore. The planned issue of 50 crore complies exactly. Post-issue paid-up capital equals 200 crore plus 50 crore divided by 125 multiplied by 10 shares into face value equals 200 crore plus 50 crore equals 250 crore. However, since shares are issued at 125 with face value 10, number of shares issued equals 50 crore divided by 125 equals 40 lakh shares. Face value addition equals 40 lakh into 10 equals 40 crore. So post-issue capital equals 200 crore plus 40 crore equals 240 crore. Promoter holding post-issue is 55%, which is above the minimum 50% required by SEBI.
Hence, QIP size and promoter holding comply and post-issue capital is 240 crore.